The week started with thin volumes and light news flow as the US and the UK were closed for holiday on Monday. So today everyone is back happily to spice up things. Oil is pushing higher since Monday on the back of rising geopolitical tensions in the Middle East. The US dollar is softer across the board on hope that this Friday's core PCE print from the US will show moderating price pressures in the US, while the European Central Bank's Villeroy revives debate about what the ECB should do beyond the June meeting. So welcome. This is Swissquote's Daily Market Talk. So yesterday was a slow Monday. The US and the UK markets were both closed. The news flow from around the world was light and the trading volumes were thin. The biggest news on the headlines were, a dovish comment from a European Central Bank member and also the rising geopolitical tensions in the Middle East that certainly helped US crude recover a part of last week's losses. So I will be coming back to the European Central Bank later in this episode, but I would like to start with oil prices first. So the barrel of US crude trades a touch below its 100-day moving average this morning. As I said, the geopolitical situation, which simply doesn't improve as Israel continues to go toward a place where international support and tolerance are wearing thin, is supportive of further gains in oil prices, along with the rising US demand into summer and OPEC's restrictive tone regarding its outlook policy that, by the way, is expected to expand to the second half of this year, and OPEC should announce that when it meets later this week. Now, China is also spending big to prop up its sputtering property market to boost growth. They announced more supportive measures just this morning to lift up home prices in China. That's a thing that also brings support to oil and commodity prices. So, in summary, sentiment in oil is tilted to the upside, but there is one major risk to rebound above the $80 per barrel level in US crude, and it is a potentially waning reflation trade. So that means that if the central banks temper their interest rate cut plans into this summer, demand outlook for oil could get hammered, and that could limit the upside potential in oil recovery. So if the yields stay persistently high, we could see the downside pressure in oil prices build stronger. Now, I was looking at the correlation between the US yields, the US 2-year yield specifically, and oil prices following a discussion that we had in yesterday's comments and market talk. And yes, the US 2-year yield and oil prices move in tandem, but if you look more carefully, what you see is when oil prices go down, yields go down as lower oil prices, lower energy prices temper inflation expectations, temper Fed expectations, and end up boosting oil prices. But when yields near a top, you see a negative pressure on oil prices as higher yields will darken the oil demand outlook across the globe and weigh on oil prices. So the dynamic between oil and yields is, basically two-sided. They interact with each other in a particular way at a particular time, and the context matters for choosing which way the thinking goes at a specific time. And in the context of reflation, rising yields is probably negative for oil prices, but lower oil prices will certainly help central banks cut their interest rates sooner rather than later. Therefore, what I'm trying to say here is I believe that when the US 2-year yield hovers a touch below the 5% mark, which is pretty much a top in this tightening cycle, lower yields would be better for oil prices. But this is just me thinking aloud. In practice, the $80 per barrel level in US crude is an important psychological resistance at this moment that also shelters the all-important 200-day moving average and a major Fibonacci retracement level. Therefore, clearing the $80 per barrel level would demand a certain external help from OPEC, for example, but keeping the prices above this level will require interest rate cuts, which in return requires easing inflation, especially in the US, while a rally in oil prices is bad for inflation. So in summary, we are probably stuck in this inferno circle until context changes. Now, I was saying that oil was one of yesterday's slow headlines. The other was Monsieur François Villeroy de Galhau, the European Central Bank, who said that the European Central Bank could well lower its interest rates both in June and in the July meetings, a comment that doesn't necessarily match the European Central Bank's official communication, in which it says a June rate cut is possible, but what will happen beyond the June meeting will depend on the inflation data, and I prefer keeping the latter in sight and in focus as a base case scenario, because if inflation in Europe picks up momentum, well, the European Central Bank can't continue cutting its interest rates. So inflation updates from the Eurozone countries will be flowing in throughout this week, but we won't see the aggregated number before, well, Friday morning. So that gives time to the European Central Bank, those, well, to dream a little bit longer on Mr. Villeroy's early week comments, and should, in theory, I say in theory, limit the topside potential in the euro. But the euro dollar is pushing higher at the start of this week on the back of a broad-based, well, weakness that we see in the US dollar. The US dollar index on its end is preparing to test the 200-day moving average against all hawkish odds. There is, well, just too much optimism that Friday's PCE print from the US will bring relief to the market. So much, in fact, that even a softer than expected Bank of Japan core inflation this morning didn't send the dollar yen higher. So if that's the case, if we see the US PCE index hinting at softer inflationary pressures in the US at Friday's release, well, we could very well see the US dollar index sink below the major 38.2% Fibonacci level and into the medium-term bearish consolidation. So that would also allow the euro dollar to extend gains above the 109 resistance, but a dovish shift in Fed expectations would also boost the dovish European Central Bank expectations, and the latter would limit the euro dollar's upside potential in all cases. So what I'm trying to say is that I don't see the euro dollar spike above the 110 level when the European Central Bank is, well, sitting on the front seat of the monetary policy easing bus nowadays. In the precious metals, well, gold kicked off this week with gains on the back of rising geopolitical tensions in the Middle East and a broadly softer US dollar, while silver rallied more than 4% at yesterday's trading session, defying the selling pressure above the $30 psychological mark. Now note that demand for both precious metals remain strong, very strong in fact, as uncertainties persist. Now zooming out, if you find yourself confused regarding all the economic data in the market and the central bank expectations, and the fact that the central bank expectations don't necessarily and every time match the economic data releases, and that the data doesn't necessarily lead the market to show moves that you would usually and in theory expect, well, you are not alone as we approach a period of fresh major central bank actions toward fresh directions, while the volatility in the market and uncertainty mount. What doesn't mount, interestingly, however, is, well, the level of stress in stock and bond markets, because both the VIX and MOVE indices suggest that investors remain particularly calm before a potential storm. But on the other hand, it is, well, quite hard to imagine that calm will persist when, well, things are about to change. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.